Well, it's time. I'm Brian Ladd with the Ladd Group at Cascade Hass and Sotheby's International Realty, and I'm really excited to have a webinar here today. We're joined by Damon Runberg, who is an amazing economist with the state of Bend. Damon, thanks for joining us today.
State of Bend, state of Oregon. But I like
State of Bend.
we really made we really boosted ourselves now. The Bend has become its own state. Instead of the Greater Idaho or state of Jefferson, we're now the state of Bend.
Well, thanks for keeping me honest. Yeah, so state economist for Business Oregon, excuse me. I
No,
was
you're
trying to
great.
think and read at the same time, and I can hardly walk and chew gum. So, for those of you that are just logging on, we have a housing update, market update today. You're probably accustomed to these, but we have Damon who's going to give us some migration data because we've had a lot of changes in the in and out migration of Oregon and Bend in the recent years. And he's going to be able to drill down to really interesting levels and to try to put to some context and some facts behind the gut feeling that we all have. And we've always found that when you have good data behind your decisions, you can sleep at night. And real estate is scary enough as is, and being uninformed is absolutely horrific. So let me go back to share my screen really quickly, and Damon, feel free to chime in at any time. What I want to get to today is if everyone could jump on that Menti poll down bottom right. There's one more time you can either snap a picture or go to your browser and enter that menti.com, and there's a code down there, 88572783. And then Ronald, who's behind the screen, would you mind pulling up that Menti poll just to see how everybody's feeling today?
We got vibes. Oh, I like this. I like vibes. Steady. Huh. It has been quite steady. Confusing. Yeah, maybe we'll be less confused after this conversation. I don't know. I'm not necessarily optimistic we'll be less confused. That's the goal, though.
Yeah, well, wonderful. Well, I actually, for some reason, I can't see that on my screen here. But then let's go ahead and jump to three specific questions that I think are going to, so we can get an understanding where you're coming from today before we drill down too deep into the data. Ronald, can you publish that first poll there? And this one is, how much population growth do you believe that Bend and Central Oregon has experienced annually for the last 10 years?
Oh, it doesn't
And
let me vote. What a shame. I had the answer.
I know you have the answer.
Remember, this is an annualized growth rate, folks. So, just I'm not gonna give you any more hints than that, but 7.5% a year would be pretty hot.
Yeah, and so the other thing is there's one of these, if you want to go ahead, is everyone seeing the results of this as they come in? Um,
There
looks
we go.
like it.
The results are in now.
Yeah, so what's funny is the first part of less than 2.5% per year was an option and nobody checked it. Damon, um, can you give us some background? What was the actual annual growth rate approximately for the last 10 years in Bend?
Yeah, I mean, this says Central Oregon / Central Oregon, but for Bend specifically, the annualized growth rate over the last 10 years was 2.6%. So, the fewest responses it looks like hit that category, and even then, that annualized growth rate is, the low end of that 2.5 to 5% option there.
Yeah, that's really interesting. And this is what you were talking about in the Impact conference yesterday, myth versus reality, right?
Yeah, yeah. I mean, there's just this perception that we are fast growing, and we are, and that's the 10-year growth rate. I think we have another questions that what
Yeah,
people
let's
think.
go to poll number two there,
Yeah,
Ronald.
I don't want to let the cat out of the bag for the 1 year. So once
Yeah,
again,
so this
context was 2.6% was our annualized growth rate for the last 10 years. So you're asking here for what was the last year specifically?
yeah, and you informed everybody, so they're kind of they're chasing your number.
And
But
actually some interesting news on this one. Hot off the presses, just published yesterday afternoon was Portland State University released the 2024 July 1 population estimates for cities and counties. So I've been using mostly the census estimates for population estimates, but we'll talk about these new estimates that just came out yesterday.
okay, Ronald, can you publish that poll so everyone sees it? Unbelievable. So even with Damon giving premise that, the growth rate is less than what people were thinking, the majority of the people are still thinking 2.5% or above. Where were we at last year, Damon?
Yeah, so the finalized numbers we had from 2023, we were at 1.3% in 2023. And the preliminary numbers that were just released yesterday by Portland State have been growing at just under 1.5%. So pretty steady from the year prior. Much slower, roughly half the pace of growth of our 10-year average over the last year or two.
And then our peak growth rates, obviously we've done this in Ben 101, are back in 1910, 1920 when we were having multiple
Yeah.
1000% growth every year.
Yeah, I think it was a
But in our
500% growth in a 10-year period of time, which I don't think we'll ever beat that again.
No, but in the last, let's say the 90s, the aughts, the tens, what was kind of our peak growth year, when we were, 50,000 plus in Bend?
Yeah, I think the best way to frame it is probably like the growth rates we've seen sort of since the Great Recession.
Okay.
Just to think of in like our more modern economy, the pre-2008 economy in Bend was so different and so much driven by the construction industry and real estate as a whole, driving a lot of the population growth and the industry growth. So if we're looking at like the 20 teens, 2016 was our fastest growth rate year we had in the last 20 years or 15 years, and that was 4.7% in a single year, which is ripping. For context, I mean, cities don't grow at nearly 5% in a year. That is really, really fast growth. And so that sort of period where we were coming out had just recovered completely from the Great Recession, which I think was roughly like 2013, 2014, if I remember correctly. So
Yeah.
the first couple years right after that full recovery were some of our fastest growth rates we've seen.
And that's where when the most salient pain or kind of the most visual growing pains were during those years. And then let's close this really quick with poll three. Ronald, could you get that up real quick? And then let's get on with it. This one is, what are some of the more pressing concerns that you would have regarding your real estate decisions? The reason I put this one out there is there's a lot of unease in the market right now. There's general sentiments. A lot of it has to do with election cycles, whatnot. But I would love to hear, if you have a pit in your stomach about making a real estate decision right now, tell us why, and hopefully we can help, provide a little bit of information around that so you can, make that proper decision to not or to, make a real estate action here in 2024 or 2025.
Hard to only pick two. There's some good options on here.
Yeah, it's funny, we had conversations with our agents. What are we hearing from our clients? What are we hearing from our clients? And it quickly, these were the ones that kept on coming to the top of the pile. Ronald, would you go ahead and publish that? Yeah, so what we're seeing here is that mortgage rates and prices, housing prices and affordability are clearly the biggest things on people's mind. Damon, are you
Well,
hearing the
and
same?
yeah, and I mean, clearly affordability is tied to mortgage rates. So,
Yep.
that you can't separate those two from one another. And housing prices are, one of the three legs of affordability. Obviously, the cost of the house itself, how much money you make, your income or wages, and then number three is the cost of borrowing if you're not a cash buyer. So that's a huge component of what affordability looks like today.
Wonderful. Well, Damon, you've got a lot of great data here to talk about today. I'm going to try to rip through a few data or housing specific things before we talk about the more accurate, the macroeconomic migration trends that you have here today. But general sentiment, let's rip through these real quick, is that there are more homes available. More signs are in yards. People are saying inventory's up. And that's what we're seeing nationwide as well. We're seeing inventory up nationwide anywhere from about 20 to 30% year over year.
This is a
And
for sale inventory. Is that what that is?
yeah, this is
Yeah.
for sale inventory. And on average, there's about 800,000 to a million homes on the market nationwide. And what we've seen is, that got down to a low of about half of that in kind of late 22, late pandemic. Nobody was moving. Everyone was locked in at their 2.8% mortgage rates. No one wanted to sell, everyone wanted to buy. And that was the low point. And we're starting to dig our way out of that. And that's what we're seeing here in Bend as well. So, what I've pulled up here is months of supply. And as a reminder, months of supply is if assuming that if no new homes came to the market, how long it would take to sell all the homes before there was absolutely nothing left. We're up about 20% year over year, and we're about 5.3 months of inventory. So, what a lot of people are saying is, hey, inventory is going up. I'm going to wait for those prices to go down. And what I want to get to next, and Damon, I would love your input on this, is the long term of this is what I just pulled up is a 20-year graph of that
Yeah.
inventory. Where we are right now is the far right of that, just over 5 months of inventory. If you remember back in the early 2000s, 2006, 7, 8, and 9, we had upwards of 20, 25, 27 months of inventory, which meant that if no new homes came on, it would take 2, 3 years to sell what was out there. It was absolutely painful. And that's when we saw that big correction in pricing. And what historically we've seen nationwide is that a balanced market is somewhere between about 5 and 7 months of inventory. When there's more than 7 months of inventory, generally sellers get a little anxious to sell their home. They'll do price drops. When there's less than 5 months of inventory, generally there's less inventory available and there's upward pressure on prices. And when you're in that 5 to 7 month range of inventory, that's historically where we see more tepid, more measured, more normalized housing markets. And that's really where we're sitting today. Damon, any
It's
thoughts on
pretty.
that?
I mean, one takeaway from this is just, when we talk about Bend's housing supply issues and that we are at a huge deficit as supply over the last decade. I mean, this graph illustrates that super well. Like
Yeah.
we've seen a slight rebound in our supply that we have, and we've rebounded back to our historical levels of undersupply, right? Like it's not historically bad anymore, but it's still pretty bad, and so one of the emphasis is when you hear people say like, we got to keep building to get those supply numbers up to what to a level that sort of allows more churn and more opportunities in the market. We're not there yet, but we're making progress.
Well, we are. And there's a couple of things I want to point out before we move on is if you look on that right side between 2019 and 2024, that's where we were acutely undersupplied. This is where we had 20 days, 25 days of homes on the market. And that's what gave that huge upward price run that we saw in 21, 22. We were having annualized price appreciation between 20, 22, 24% year over year. And that was horrifically painful. And now that we're starting to come back out of that, we're becoming more normalized. But a lot of people are saying, hey, if the inventory is going up, aren't prices coming down? I laid over two graphs, and I would have rather had an economist do it, and I used ChatGPT to do it. But I overlaid
Oh,
the
fancy.
inventory graph versus pricing trends. And what was really interesting is that the kind of the rollover tipping point towards price depreciation in housing happened somewhere around 9 to 10 months of inventory. And that makes sense, right? Like if it took you 9 or 10 months to sell your home, chances are prices are going to have some downward pressure. So, we're still roughly about half of where, I was able to find as the real acute tipping point for price corrections.
Well, and we
And
also
that's,
often think housing
yeah,
housing prices tend to be thought of as sticky prices, as
yep.
in they go up quite easily, but they're sticky to come down. We see the same thing with wages, by the way. It's sort of the same concept where the general trend for wages over time are stair steps upward, but not a lot of sort of drops in those. And yeah, like the circumstances that would lead to a significant price drop would have to be tied to some sort of major recession and people being desperate to get out from underneath mortgages that they have. Right now, we don't have people desperate to get out of mortgages because unemployment is at basically historic low levels. And people are locked into super low interest rates for the most part that are quite affordable within the budgets that they have. So there's not a lot of urgency for someone to offload a house. And that urgency is often what creates the scenario where you'd see a price depreciation.
Yeah, agreed. And so to go back to the beginning, when we polled everyone, what are they most worried about with housing? It had to do with affordability and interest rates. Obviously, they're tied. But let's get to that. So the interest rates are not directly driven by the Fed funds rate, but they're correlated. And we've done whole webinars on all the multitude of factors and the 10-year treasury bond and the spread and all that that relate to mortgage rates. But in general, and Tim, what was it, Mahady,
Yeah, yeah, he was great
presented
yesterday.
yesterday. He's an economist. He actually worked for the Fed, now has his own firm. He really said, hey, the Fed has two primary objectives: full employment and stable prices, right? And if we're going to try to get some outlook on where mortgage rates are going to go, we're going to have to get our head around kind of what the Fed is looking at. And if those two objectives are full unemployment and stable prices, let's just pick those off. Let's start with stable prices. Where are we at right now with inflation, Damon?
Yeah, I mean, we've made some really impressive improvements. It's there's a lot of people have a bad taste in their mouth around how they feel about the economy today. Although most economists in the back are all like celebrating and cheering because we just had an unprecedented scenario where we've managed to keep an incredibly robust labor market with very few layoffs, almost historic unemployment, low rates of unemployment, businesses continuing to slowly grow yet see inflation come down. This is the inflation chart here. You can see how much improvement there's been there, and we're not quite to the Fed's benchmark rate there. You can see of 2%, but we're getting pretty close. Although it's that improvement, that last half percentage point is a bit sticky for us to get past that threshold. But it's been an impressive improvement, and the way we got there was through the high rate environment, really pumping the brakes on spending, taking money out of circulation, disincentivizing spending, has helped to solve some of the inflation issue. And inflation, at the end of the day, is too many dollars chasing too few goods. That's sort of the economist lingo for it. So that's your your sentence you could take home: too many dollars chasing too few goods. And so when the Federal Reserve makes it more expensive to borrow by increasing rates, it means that there are fewer dollars out there chasing those scarce goods, and that has really helped alleviate this pricing problem we've been in.
Yeah, well, thank you. And then the other tenet of that is full employment, and nationwide we're at 4.3%, historical average almost 6%. Where do we stand here in Bend right now, Damon,
Yeah, well, I
or
mean, we're
Central?
right we're right at 4% here in Deschutes County, and the state is right at 4% as well. I mean, the state, the nation, and the county are all neck and neck with each other when it comes to unemployment today. And then, like you said, that is historically low. I mean, the lowest on record is maybe like 0.3 of a percentage point lower than where we're at today, but statistically, it's insignificant from historic lows.
And I hate to even put this slide up here because I hate projecting where mortgage rates are going because there's about a million assumptions in there. And even Tim said yesterday, he goes, there's very little consensus or a lot more disparity on consensus on where mortgage rates are going to, or the Fed funds rate is going to be more than ever, et cetera, et cetera. That said, given the data that we're seeing, most of the economists, Fannie Mae, Wells Fargo, NAR, are predicting a fall in interest rates, whether that's linear or not, whether it's stickier for longer or not. The consensus is that we're in a longer term softening environment as far as mortgage rates go, rather than an increasing, or at least there's more, there's less upside risk than there is down right now. And the consensus, and I'm not wholly bought into this, is that the interest rates for mortgages by the end of 2025 will be somewhere between 5.5 and 6. If it were to be that strong, because we have such pent up demand for housing, it's absolutely going to be bonkers out there. If we go sub 6%, we're going to have an absolute buyer's market. I doubt we'll actually see these rates that they're predicting. But Damon, I'd love your thought on that as we go into 2025.
Yeah, I mean, Tim's comments I think were really astute yesterday that there was this confusing period where the Fed dropped the Fed fund rate by half a basis point, and at the same time mortgage rates actually went up the
Yep.
very next week. Markets have for the most part have taken into account what the Fed has already said into the next year, and they basically price those cuts into Treasury yields, and it's not a great sign that we haven't seen a lot of improvement here. I think some of these forecasts are probably optimistic, because at the end of the day, what the Fed is doing is they're there to fight inflation, the stable pricing concept. Um, and as a result of the election, with Trump getting elected, there's a lot of concern in the markets that is going to be there's going to be a lot of inflationary price pressure, from a handful of policies that he was advocating for in the campaign. In particular, some immigration policies are highly inflationary. No matter what you think about immigration, if you deport labor out of the U.S., then that makes the available labor that's here. You see big increases in wages because the supply of labor goes down. So that would be highly inflationary. And then the other one's tariffs, are obviously quite inflationary, and most of those tariffs get passed on to consumers. So if we see a resurge in inflation, then the Fed is going to be forced to double down and sort of reverse their rate cutting stance. I think they're probably going to be like let's wait and see mentality. So I don't think they're going to do any abrupt reversing of their course right now. And my hunch would be we'll see rates slowly drop, but no aggressive dips or anything out there. And I don't know what your thoughts were on this, Brian, but Tim's response, I thought maybe every real estate agent in the world was probably like, hell yeah, after hearing what he said when he said, um, for all of you sitting on the sidelines trying to predict what the rates are going to be for buying a house or buying a car or investing in your business or whatever it might be, and thinking that I'm going to sit on the sidelines for another year or 6 months or 2 years, whatever it is, until the rates are more optimal. He said, don't. If it's the right decision for your family, for your business, for the needs that you have, buy the thing right now, because there is no guarantee that the rates 6 months from now, a year from now, are going to drop to a point that 5.5% might not happen. So don't bank on it necessarily.
Well, thank you for saying that, because when the words come out of a real estate agent's mouth and they don't trust it. But yeah, I mean, what he's basically saying is, and I was in whole agreement, I actually had written down that quote, is that this is really a personal financial decision. There's not a clear trend that those interest rates are going to drop in the near future. So operate with what you know now. Does it make sense for you long term? Does it make sense within your personal financial picture? And if so, make your decisions. And what we've generally seen with housing is it's time in market, not market timing, anyways. And the other thing that we saw, and there was a brief time period in September where interest rates dropped. They had gotten down to right down near 6% or so. And they had a brief drop, and sales went bonkers. We had more contracts in September than we had in the previous 3 or 4 months. And then as interest rates went back up, sales slowed again. What that tells me is that there's pent up demand for the housing that we have. And if someone's waiting for interest rates to come down, unfortunately, as those interest rates come down, what I've been seeing is that as soon as they come down, more and more buyers enter the market. So you're going to pair those lower costs of interest rates with more buyer competition. So this is really a kind of a personal
One
decision.
one thing I'll push back on a little bit on that is one of the issues with our suppressed supply right now, is the people sitting on the sidelines, right? These people locked into low interest rates, and they're like,
Yep.
maybe we want the next house. Like we want a bigger house, we're growing a family, or we want a smaller house, we're retiring, we're downsizing, or we want to move some, whatever it might be. But you got this really low interest rate and you're just like, man, I can't do anything because it's such a good deal. There's a scenario where if interest rates come down, yes, that spurs buyers who were being priced out of the market before because of the high interest rate environment, but it's also going to spur sellers
Mhm.
to create more churn in the market. And so I would caution that we would necessarily be worried about a huge sort of price increases in the scenario of lower interest rates. It's also possible we see much more inventory with lower interest rates because normal churn, where people are just buying and selling within the same market, has like dried up completely right now.
It's gone, yeah.
It's gone. And so it could create opportunities that people are like, yes, I'm not stuck anymore. I could move. I could sell this house and buy the other one. And that, would still lead to maybe some marginal price increases, but the fear that it would be like, you know, astronomical increases in home prices in that scenario, I think the supply increase might mute some of that increase a little bit.
No, that's a really good point. Thank you. We did a webinar a couple months ago where we actually had a graph on the percentage of homeowners at different interest rates. And I believe it was like 90% have interest rates five or below.
Oh
And I
yeah,
think it
yeah,
was some like
nationally.
75%, 4% or below. So there's real interest rate trapping. And it's going to be interesting to see what that rate delta between the interest rate that they have on their house on what they're going to replace it with, at what point is it going to incentivize them to move? Because if they have a 3% loan and they have to go to a 7.5% loan, even if they downsize a house to, 2/3 the cost they're in right now, their mortgage payment's going to go up. So it's really going to be interesting to see, but there's a lot of pent-up demand with people getting divorced or death in the family or having new babies or kids going off to college where they're in the wrong house. And it's going to be interesting to see at what point they just say, I need to get on with my life. And it'll be interesting to see how that plays out.
Yeah, you can't at some point you just gotta move on. And I think for all of us knowing that like we're never going back to the sub 3%. We're probably never going back in the next decade or more to in the fours. Like that, I could almost with a straight face guarantee we're not going to see the fours in the next decade again, because the Federal Reserve made such a big mistake by dropping the rates that low. And that was like a 20 in hindsight, Vision's 2020 thing, and the Fed caused about 1/3 of all the inflation we experienced during that inflation spike because of the low interest rate environment. So, this idea, once again, for the advice of folks like make choices for the here and the now that fit your financial situation. There's likely not a scenario where if you're waiting for the 3% rate to come back, I'm sorry to tell you, it's not coming back. That was maybe a once in a lifetime scenario for folks to get into.
Yeah, and we've actually been advising a lot of our sellers of saying, don't sell, buy that next house, use somehow tap the equity in the other house, keep it as a rental. It can actually be a secure part of your financial
Yeah.
portfolio. But there's going to be a lot of houses that don't sell until those mortgages are up in 25 years. And
Yeah.
so, but anyways, given this, prior to the election, prior to some of the inflationary things that we might see with some of the new policies of the Trump administration, everyone was saying that, hey, next year we're going to have more tepid price appreciation nationwide. No one's really predicting price corrections, somewhere between flat and 4 or 5%, which is a relief to me, normal, that's dependable. And that's about what we're seeing here in Bend. Over the last year, we were up 3.1% year over year for a median price. That is for all housing types. For single family, it was over 800. But it's definitely not the crashes that we saw in 2007, 2008, nor the craziness of the pandemic. To me, this is much more of a healthy, normal market and a sigh of relief to me.
Yeah, what a wild graph, by the way, though. Just that pandemic surge in pricing is nutty. And you could see the moment that interest rates started to go up there and demand
Yeah.
started to wane, all of a sudden, look what happened on pricing there. I mean, it had if you ever question whether or not higher rates, the Fed's toolbox is effective at fighting inflation, you could look at this graph here and say, that moment in 20, you could see basically 2023 there is when the rates started to turn the corner and our prices moderated quite dramatically and saw slow and steady price increases, which is a good thing and a healthy and predictable thing for our market.
Yeah, absolutely. And then I could do a whole nother 2 hours on this with you about traditionally housing was a 7 to 10 year cycle with price corrections built in because developers and builders could oversupply the market. And we kind of glossed over that slide, but we're in a 10 plus year undersupply. And there's a million reasons for this, from land entitlements to utility availability. We're not going to go there today. But given that dramatic increase in prices, that dramatic increase in mortgage costs, if we were in an oversupplied market, we would have seen a price decrease. But that's what stopped that downside and that pullback from those highs. But Damon, I've already spoken too much. We're to some of these slides that I have no wherewithal talking about, and the ball's in your court.
All right, well, let's talk about a few trends here. I mean, obviously, one of the things that when we're talking about housing, housing is us. It's all of it's an essential good that we all need to have if we live in a community. And so the housing market is driven by population growth. It's driven by demographics. Sort of the are we seeing people entering their house buying years? Are we seeing folks aging out of housing as they retire? And at the end of the day, migration is driven largely by employment opportunities. People migrate to where jobs are available. Bend is a bit of a funny, a funny anomaly, I suppose, in that regard, where we have opportunities for people to work here. Virtual work, remote work is a bigger thing nowadays. And so we're not as exclusively tied to the local employment situation as far as what migration patterns look like in the housing stock. We're also a draw for retirees, so that's also a disconnect a little bit from the local employment situation. But either way, it's still an important thing to look at. And excuse me, when we're right here, we could just sort of see Central Oregon's or Deschutes County's employment trend here, the orange line one, compared to the rest of the metro areas across the state. And if I showed you a graph that had like a 10-year or a 20-year trend of Deschutes County's employment index compared to all the other metros, the gap between our line and everyone else would be massive. There'd be a lot of black space between our lines. And what you see here over the last 5 years is we kind of look a lot like everyone else. I mean, we're still leading the pack as far as metro areas, but you can see there that we're just slightly above the Salem metro area, and in the last year, our employment growth's only gone up by about 0.2%, which is molasses job growth for us in Bend.
Yeah, and that one was real surprising to me. And then we were talking about this yesterday, the real threshold and the stop on this, because there's jobs wanted, or job openings,
Yeah.
but it's the threshold of the cost of housing for people to migrate in. And so we've kind of put our economy on standstill because of our high barrier to entry with housing costs, right?
Yeah, absolutely. I mean, one of the saving graces though is that we've seen a lot of multifamily rental units that have come on the market in the last decade, and that has
Yes.
really helped create opportunities for folks out there. But yeah, this is a major barrier for future economic growth is the housing prices that we have, and future barriers for businesses expanding here or new businesses opening establishments in this area. Is just that high cost environment we're seeing is really troublesome from a statewide perspective, but it's far more extreme here.
Yeah, and I'm not sure. Thank you. And I don't know if how much into the details you want to get on this graph, but this is what us versus everybody else on kind of how our economy is growing and or our job market.
Yeah. I mean, we got to that 0.2% growth year over year, so basically flat. We got there through a variety of shifts. See, when we actually look at sort of industry changes, you see, first of all, one thing that will stand out is that Deschutes County's patterns for employment growth over the last year look really similar to the state as a whole, which once again is also not usual. We tend not to look like the state, and we've been very Oregonian here in Bend the last year, where the biggest growth has been in healthcare, which is a huge one. Now, healthcare is driven largely by a larger population and an older population because older folks disproportionately demand health services. So that explains a ton of that healthcare growth we see at the top there, both at the state and here in the county. Government's grown a ton. That's mostly K-12 education that we've seen that growth. And this year was a real strong hiring year compared to last year. But the one that just got to draw everyone's eyes is the big drop there in leisure and hospitality. That the about 9% drop in the last year. So this is September data, so it's September 23 to December 24. And it's important to note, though, that September was a really smoky month for us. And so it makes sense that we would have seen a lot of our tourism related businesses do some layoffs during that period of time because of poor visitation numbers associated with the smoke. So I don't think that that negative orange line that you see there for leisure hospitality is quite as terrible as it looks, even though this summer visitation was down a little bit on average compared to what it was in the last couple of years.
Yeah, I was actually at the Powder House Ski Festival last night, Damon. Didn't see
Oh,
you there. I know
nice.
you're a big skier.
Yeah.
But Dan, who runs Pine Mountain Sports, he was talking about this being a very tough retail year for him.
Mm.
And so I think that some of that pullback in leisure and hospitality is showing up.
Yeah, I mean, one of the people's distaste for what the economy feels like today has a lot to do, with having to say no to buying things. Inflation and higher costs of borrowing meant that like people are like, oh shoot, I have to say no to the thing,
Yep.
and the things
And
we
it
tend to say
looks,
no to for rec, well as sort of luxury goods as well.
yeah, not everyone needs a new $5,000 mountain bike, and a lot of those people bought those mountain bikes during the pandemic. So, but
Exactly.
yeah,
Yeah.
so yeah, yeah. But what about unemployment? You talked about this before, so we probably don't need to spend too much time on this one. I think I'm losing Damon a little bit. So, Damon, if
Yeah,
you can hear me and you
we can
need
skip over
log
this one. We
back
already
in.
sort of talked about unemployment, but you can see this is a I got you now.
I
Would it
got you.
help if I took my video off for a second?
Yeah, go ahead and take your video off.
I'll
Perfect.
try that. Does my audio sound okay?
Yeah, perfect.
Okay, perfect. Yeah, I mean, the only thing worth noting on this is just look at that long run history of the unemployment rate. This is a 25-year graph here. I mean, this is a quarter century of unemployment rates. And to give some context for how tight the labor market is today, I mean, it is really, really low rates of unemployment today. So that's just one thing worth noting.
Yeah, man, I remember the painful days of 14% unemployment in Central Oregon. Or Deschutes County. It was a very different world than what we're at today.
Yeah.
What
So
about
then,
the
we could move
population
into
growth in general? Yeah.
yeah, yeah. So I mean, obviously, we've talked mostly about sort of job opportunities, labor market stuff, but at the end of the day, population is probably the biggest factor that affects our sort of conversations about housing and how housing interacts with with some of this economic data. At the state level, so this is state data right here. We've seen some mixed messaging from the folks who actually do estimates of population growth for the state. Both the Census Bureau and Portland State University are the two organizations that do it. It doesn't really matter which one of these lines you believe as far as total population in Oregon, but the moral of the story is the pandemic has been a period of very, very slow population growth or even some modest declines in the state of Oregon. So we've seen some real softening there for population.
Let's talk about the in and out migration a little bit because the consensus is that during the pandemic, we were flooded with people migrating in, and perhaps we're on the backside of that now. Do the numbers match that discussion, that myth?
Well, it's interesting. There's two myths that exist out there. There's the myth that Oregon became a place where people were leaving in aggressively during the pandemic. That was one myth. And
Okay.
then there was also a myth that Bend, inversely, on the other end of that, that Bend was growing super rapidly, right? So there's like two conflicting myths out there, both within the same sort of broader geography. Number one, so what we're looking at here, this is migration patterns, in migration and out migration in Oregon, not Bend, comparing the 2022 year, which was the most recent migration data we had, to what was normal before the pandemic. And the blue bars there represent in-migration into the state, okay? And what you could see is that during the midst of the pandemic, we saw migration into the state as strong as it was before the pandemic. And so there wasn't like Oregon wasn't less attractive. But what did shift and led to the softening population numbers in Oregon overall was our out-migration increased. We saw more people leaving the state than what was normal. And so on net, that actually led to some negative net migration numbers for a few years for the state as a whole. But once again, that's not a Bend story, that's a statewide one. And shifting to this graph here, at the end of the day, the net migration numbers, this is a 3-year look, looking at 2020 to 2023. So over the last 3 years, Portland State says that Oregon as a whole has netted just 7,400 new residents through migration. That is a really, really low rate of net migration. But the elephant in the room here is our natural population change, which is the difference between deaths and births in any given period of time, is very, very negative. I saw a hand that was raised a second ago.
I think that was me on accident. But while we're on that, if anyone has any questions, please put them in the chat box or the Q&A, and we'd love to have a 60-way discussion. But no, I think it would be fun
try my
to have
video.
There you go.
Thank you so much for these explanations, and sorry for interrupt you guys. But we have a question here from Raul. If the mortgage rates normalize to 6 to 6.5% per year, how it is going to affect the prices of houses? What will happen to the rental market with all these new multifamily units coming to the market? That's the question.
Awesome.
Yeah.
Damon, do economists take cracks at things like that, or do you want me to, or let's do it?
I'll let you mostly do it, but I'll say one thing about it, which is that there was sort of a part of that question that had to do with if they normalize. I think at the end of the day, one of the best things that can happen to interest rates is they just become consistent. They sort of, we find a place that works and it sticks there for a while, because predictability in the market is one of the biggest things. It's this anticipation that tomorrow is going to provide lower rates while people sit on the sidelines, or fear that the rates will be higher, or whatever direction they might go. Stability is the key for us finding sort of a happy place in a lot of these markets, including housing. So that just, you don't hear people say that very often, that it's just like whatever the rates land at, someplace stable is what we want.
Yeah. Okay. And so I'm gonna as we talked about before, kind of two things: rental and housing prices. Housing prices, my gut feel is that the pent-up demand that we're seeing with the amount of buyers that we have in the wings, my feel is that if we're somewhere between that 6 and 6.5%, we're gonna be on a continued track where prices should appreciate at fairly normal rates, perhaps maybe a little bit above that. That's a gut feel. That said, what Damon's saying is all the people waiting in the wings that have been sitting and not selling their homes, they're eventually going to come to the market. Whether 6 and 6.5% is enough to bring a lot of that inventory to market or not is yet to be seen. Anecdotally, our team has more listings coming out next spring than we have in a long time. So I do think there will be some inventory. That one's a tough one to predict, but I think that a falling interest rate brings back both buyers and sellers. So I don't think it's going to necessarily change the price trajectory that much. What I do see happening, and this is a little bit unrelated, is that rental rates are softening. And I think this is a sigh of relief for a lot of people out there. What I've seen with and experienced with the rental home that I have, and that the rental management companies that I speak with as well, is that I've had to drop rent rates a little bit, and rent rates have dropped, and it's not showing up in the data yet, but my gut feels is that most of the renewals that are happening right now are somewhere between 10 and 15% lower. So there is a softening in that rental market, and a lot of those new big apartment buildings that are coming on are helping soften that. And then that's kind of working through the chain a little bit and softening the townhome market a little bit, which then softens the single family market a little bit. Even though we have a single family and townhome shortage, that overabundance of the apartments that are coming on are helping provide some price rental relief for renters. So
you're saying supply and demand works, Brian.
It's working.
Novel concept.
Yeah, what's really frustrating, and I could go tangential on this for an hour, is unfortunately there used to be a step in that price ladder where people would rent and then buy their first condo and then buy their first townhome and kind of work their way through. The condo is really a missing rung because of all the liability with lawsuits around with condos, and condos are very expensive to build. There's not many condos coming on the market. So all these big buildings that are coming up, generally the investors are holding those and renting those. So we don't, so the first rung that a buyer into our market has to grab is a townhome. And that is a really high price right now. So we don't see many condos coming on, but I do see price rent relief overall.
Yeah, good question. Could we go back one slide to the Bend population numbers? There we go. So we were talking a second ago about the statewide population, and that there's been a lot of softening at the state level. And once again, Bend is always different than the state as a whole. We live within Oregon, but we're a very small portion of it. Um, there was a label that we got during the pandemic. Bend was labeled as a Zoom town, as one of those towns that blew up because of the pandemic, and all these remote workers migrated here aggressively because of quality of life reasons. I got some bad news for y'all. We are not a Zoom town. We were not a Zoom town. You can actually see that our population growth rates tanked during the pandemic. We saw some of the slowest growth rates we've ever seen in the last 20 years in the midst of the pandemic years. And by the way, the 2024 numbers, like I said, just came out. And so this graph isn't updated yet, but it goes, the 2024 numbers just under 1.5%. So for 4 consecutive years, we're in that 1.5% or lower for annualized growth rate.
Wow. And I'm on the front lines of this business, welcoming people new to town. And even though I'm on the front lines, I would have not guessed that. And that data is shattering my perceptions of what happened during the pandemic.
Yeah, I think the reason why we feel that way is because there was a run on housing because of the
Yeah.
low interest rate environment, but that didn't necessarily mean that there was a run on new residents, if that makes sense. And so when the housing supply disappeared, everyone's like, well, all these new people are showing up and they're buying the housing stock. And it was like, actually, there's a lot of second homes, or a lot of folks who are, who weren't homeowners, who are buying their first home, or whatever it might have been. That market got eaten up really quickly in there. The other thing, the reason why, the thing that sort of concerns me, or like you got to ask the question, is like, is this a long-term trend here where our growth rates have dropped and have to this lower pace? And why is it staying subdued like this? And I think a lot of it has to do with Central Oregon's cost of living. It's incredibly difficult for a lot of folks sort of making average wages to make it pencil here in Central Oregon. And so we can't really sustain those high rates of growth with housing costs where they're at and where housing supply is at. The market just, we can't physically grow much faster than we are now until we start getting more inventory.
Yeah, so we got a couple questions here. We'll try to address them real quick. First, obviously, there's a huge disconnect in the price of housing and the jobs that are available. Absolutely. We have a slide on that coming up that can allow local people to afford purchasing. Agreed. Hallelujah. We're in full agreement there. This is a huge impediment to economic growth. Are there any solutions to this dilemma? Hot potato, Damon?
Yeah, well, the Economist response to that is always build, build, build. I mean, you were just telling anecdotes about how we've seen really aggressive softening on the rental market pricing because in a lot of ways of this history of 10 years of really great multifamily growth and rental unit growth that we've had in Central Oregon. It works. More housing units in a housing constrained community leads to softening prices, and so. I think the one thing we can do is just keep building more housing, period. And it's one of those situations though that's not a good answer for someone looking to buy a house right now, because markets normalizing and getting to a point of equilibrium may take us 5 years, 6 years to get to a point where we actually have caught up on this inventory problem.
Yeah, and the second question to this is, and I'll chime in on that a little bit. There is what I've seen more is that governments are acutely recognizing the housing shortage now that 2, 3, 4, 5 years ago they weren't talking about. And it's a big initiative, both locally, statewide, and nationwide, where they're trying to lessen the burden on developers, try to bring on more land. There's a lot of land use laws in Oregon where they can't just sprawl out and start building out subdivisions. It's driven from the state. The state mandates what the growth minimums are for each city, how they do it, where they do it. Urban growth boundaries take 10 to 15 years sometimes to expand. That said, they're doing some emergency actions at the state level that allowed Bend to annex in some additional land without having to go through urban growth boundary. There is relief on the horizon. Can it come fast enough? No. But they're trying. And what I like finally is that housing is not a bad word, because I think people are finally realizing that it's not a given that there's ample housing, and it's showing up with the people that are experiencing houselessness in our market, in our area. It's showing up that job growth has stagnated because people literally can't afford to live here. And I think that people understand that growth is not all bad, it's bad growth is bad. And that finally people understand how integral housing is to all other aspects of life, whether it's economically or societally. So I'm reassured that that's finally on the forefront of the minds of city council and the mayor and the planning division, and they hear it. And we've been beating this drum for years and years, but I think it's out there. The other question that we have, well, this is more of a guess. It's saying how much more expensive or cheaper is the cost of building a new home from 2019, labor and land? Unfortunately, I would probably have to guess double. And maybe not so much double on land, but at least double on costs of labor and materials. And what Damon was talking about is economically, prices are sticky. Once they go up, it's hard to bring them back down to the previous level. And we've seen that with material costs and labor costs, and they really haven't pulled back. So you're seeing that on labor and rates, right, too, Damon?
Yeah, I mean, the labor costs are particularly sticky, and that's the one that's been problematic for, we're not seeing that come down. Materials have come down quite a bit though, especially during, early in the pandemic. You remember we sort of joked that, you should go buy a bunch of 2x4s and put them in your backyard and store them for a bit under a tarp, and then resell them for a 200% markup. We're not doing that anymore. We're doing okay when it comes to building materials, but yeah, the labor piece is still incredibly expensive. And once again, there's no expectation that we're going to see any moderation on wages when it comes to construction employment there.
Yeah, and let me go back to and I apologize.
Yeah, there was one last slide. Go to the last slide on this, because the last question we had, I think, really hits on that question. That question is sort of about like, hey, how does the local person pay for a house here? Like, how does that even pencil? One way to think about that is, so on this, there's a lot going on this graph here, but on the x-axis, the horizontal axis, is the price increases we've seen during in the pandemic era. And so the further right you are on this graph, it means the faster your home prices have grown in the last 4 years. The vertical axis, the y-axis, is a measure of the number of years, of years of the average wage it would cost to pay for the average home price. Now, nobody does this. Nobody's like, I'm going to pay 100% of my wages for 3 years to buy my house. Like, but it is a good way to normalize home prices relative to local wages. I made this for a statewide event and not for Central Oregonians. So as a courtesy to us, I threw on a red dot here to show where Deschutes County is on this graph compared to states all across the US. And you could see Oregon there is sort of to the bottom left of Deschutes County. So, we're looking at roughly like 6.5, 7 years of the average wage equals the average home price in Oregon. And it's over 10 years of the average wage to equal the average home price for us. And that's in Deschutes County. It's even worse if we look at Bend specifically. The only saving grace is we could say we're better than Hawaii, I guess, when it comes to affordability relative to wage earners. But also, this is taking into account only local wage earners. And it's a good reminder, for better or for worse, our market is influenced by other forms of income, including retirement income, as well as the fact that like remote workers who come with generally higher wages aren't captured in the local wage, the local average wages. So if we were able to somehow normalize it and account for those telecommuters, the remote workers and the retirees, the Deschutes County number might look a little bit better. But it's just sort of an unfortunate component of our housing prices are tied to other things besides just local wage earners.
Wonderful. Well, I think we went through enough today. Damon, I cannot thank you enough for dedicating an hour of your evening. You're incredibly valuable for our community to have as a resource. If anyone has any follow-up questions or subjects that didn't get addressed and you'd like Damon to answer, please respond back to that Zoom invite that you got for this. We'll be happy to respond and answer and put you in touch. But once again, Damon, thank you for joining us tonight.
Hey, my pleasure. Thanks, Brian, and thanks for all the hard work you do in our community.
Oh no, it's least we can do. And whoever asked that question about housing prices and affordability, we're on it. It's a primary focus of what we're doing at the Lad Group to try to add, lobbying efforts and pressure and support for housing affordability in our community. It's at the forefront of what we do on a daily basis. So we hear you, and we'll do our best as well. So anyone who has any questions, please reach out. Once again, thank you for your hour of time. Wow, we usually try to keep these to 20 or 30 minutes, but we covered a lot of material tonight.
Hey, it was easy talking to you.
Okay, Damon, I saw your dog in the background. Go take care of your dog. And I actually have my wife just brought in our third dog. We just rescued one from the
Oh my
Humane
gosh.
Society.
It's too many
So
for me.
I've got a crazy night ahead of me. I'm gonna go take care of that dog, and I appreciate your time. Thank you,
Awesome.
everyone.
Thanks, Brian.
Much
Have a good night,
appreciated.
everyone.